A breakout above a key resistance level. Volume surging, RSI pushing through 60. Every technical signal lines up. In a bull market, this trade works. It runs 15, 20, sometimes 30%. In a bear market, this exact same setup fails. It reverses immediately. You take a stop, the stock continues lower. Same pattern, same signals, same execution, completely different outcome. The difference isn't the setup. The difference is the market regime you're trading in. And most traders never check it first. Over the last 9 episodes, we built a complete technical analysis toolkit. Chart patterns, indicators, volume, moving averages, momentum, Fibonacci, VWAP, sector rotation, watch lists. But all of those tools share one critical assumption. You know what kind of market you're operating in. Today we fix that. Before any setup, before any trade you need a regime filter. I'm going to show you how to do it. Using 2 tickers, 2 moving averages and their slope. Then ChatGPT synthesizes what the data is actually saying. 3 prompts, 10 minutes, done once a week. Prompt 1. Spike moving average structure and slope A. Classify the large cap regime. Prompt 2. IWM confirmation. Do small caps agree? And what does any divergence mean? Prompt 3. Regime to strategy translation. What does the regime tell you about how to actually trade? Let's go. A market regime is the dominant trend environment the broad market is in right now. There are 3 that matter. Bull, the market is trending higher. Price is above rising moving averages. Large caps and small caps are both participating. Setups work at a higher rate. You want to be long, fully deployed, and letting winners run. Pull back within a bull. The trend is still up but price has pulled back below a shorter-term moving average. This is not a bear market, it's a buying opportunity. But you need to recognize it correctly, or you'll sell at exactly the wrong moment, bear. Moving averages are declining, price is below them. Setups fail more often. Even technically clean patterns have lower hit rates. The correct response is to shrink position size, be far more selective, or sit out entirely. The mistake most traders make is ignoring regime entirely. They apply the same strategy. Same setups, same position sizes, same aggression, regardless of whether the market is trending up or breaking down. That's why the same strategy produces a 35% return 1 year and a 25% drawdown the next. 2 tickers, 2 moving averages, 1 overlooked input, slope. SPY is the S&P 500 ETF or large cap stocks, the institutional benchmark. When SPY is healthy, money is flowing into the market's biggest names. IWM is the Russell 2000 ETF or small caps. Small caps are more sensitive to economic conditions and risk appetite. They tend to lead at major turning points, both tops and bottom stakes, before SPY confirms the move. When SPY and IWM agree, the regime signal is clean. When they diverge, carry one trending up while the other struggles. That's a warning. For moving averages, I use 2. The 50-day and the 200-day simple moving average. The 50-day reflects intermediate term trend, what institutions have been doing over the last 2 months. The 200-day reflects the long-term structural trend, but the number alone isn't enough. The slope matters. A 200-day moving average that's rising is a completely different signal than a 200-day MA that's flat and beginning to roll over even if price is at the same position relative to both. Rising 200-day, institutional money is flowing in, real momentum. Flat 200-day, the trend is losing conviction, caution warranted. Declining 200-day, structural bear market. Bounces are selling opportunities, not buying ones. To run prompt 1, pull up any charting platform. TradingView works fine and gather 5 inputs: SPY's current price, the 50-day SMA value and its slope rising, flat or declining the 200-day SMA value and its slope, whether price is above or below each moving average, and whether the 50-day is above or below the 200-day. Then paste this into ChatGPT. I'm going to give you SPY's current technical data. Analyze the moving average structure and slope to classify the current market regime. Current SPY price, your number here. 50-day SMA, your number A slope, rising, flat, or declining. 200-day SMA, your number A slope, rising, flat, or declining. Price versus 50-day, above or below. Price versus 200-day, above or below. 50-day versus 200-day. Golden cross, death cross, or converging. Based on this data, describe the moving average stack. Are the moving averages properly ordered? Or is there compression or inversion? Interpret the slope of each MA. What does a rising, flat, or declining 50-day and 200-day tell you about momentum and institutional participation? Classify the current regime as one of AA bull, price trending above rising MAs, BA pullback within bull, price below 50-day but 200-day still rising, CA neutral mixed signals, DA bear, price below declining MAs. Explain your classification in plain English. What would need to change to shift the regime in either direction? What you get back is a structured regime classification grounded in actual data, A, not a gut feeling, not a headline, not a narrative. In a clean bull, price above both moving averages, both rising, 50-day above 200-day. Proper stack, you want to be buying. In a bear, the stack inverts. Price below the 50-day. 50-day below the 200-day, both declining. Every bounce is a potential exit, not an entry. The SPY analysis tells you what large caps are doing, but large caps can hold up on momentum A, mega cap tech, defensive sectors A, even as broader market conditions deteriorate underneath. IWM doesn't have that luxury. When institutional risk appetite drops, small caps feel it first. They're less liquid, more economically sensitive, and the first to get sold when money goes risk off. That makes IWM one of the most reliable leading indicators for market health. Gather the same 5 inputs for IWM, then run this prompt. Now analyze IWM using the same framework. Current IWM price, your number here. 50-day SMA, your number A slope, rising, flat, or declining. 200-day SMA, your number A slope, rising, flat, or declining. Price versus 50-day, above or below. Price versus 200-day, above or below. 50-day versus 200-day. Golden cross, death cross, or converging. From the previous analysis, SPY was classified as. Paste your classification here. Now, analyze IWM's moving average structure and slope independently. What regime does IWM suggest on its own? Compare IWM's signal to SPY's. Are they confirming each other, or is there divergence? If SPY is bullish, but IWM is struggling below its 200-day, what does that signal about the breadth and durability of the current trend? Update the regime classification A. Does IWM's data strengthen, weaken, or complicate the signal from SPY alone? The key output from this prompt is regime confirmation A or a warning. When SPY and IWM agree A, both trending above rising moving averages, both with clean stacks ACE, the signal is strong. You can be aggressive. When they diverge, ASPY holding up, while IWM struggles below its 200-day A, that's a warning. The bull market is narrowing. Breadth is deteriorating. At some point, large caps follow small caps lower. This divergence has historically preceded major market tops. It doesn't give you an exact date, nothing does, but it tells you the risk environment is shifting before SPY itself breaks down. You've classified the regime, now translate it into concrete trading decisions. This is where most regime analysis falls apart. Traders say it's a bull market, and then trade exactly the same way they always do. They don't adjust position size. They don't shift their setup preference. They don't change their risk posture. Prompt 3 does that translation. Based on the regime analysis above A paste, the complete output from prompts 1 and 2A create a trading brief for the current regime. Include 1A regime summary, 1 sentence naming the current regime and the key evidence for it. 2A position sizing, what percentage of total capital is appropriate per trade in this regime and why. 3A setup preference, which setups have the highest historical hit rates in this regime, breakouts, pullbacks, mean reversion, trend continuation, which setups to avoid. 4A risk posture, should stops be tighter or wider. How does the regime affect willingness to hold through normal drawdowns? 5A sector and instrument focus, which sectors or asset classes historically perform best in this regime? What to avoid? 6A regime shift triggers, what specific price action in SPY or IWM would signal a regime change A, and how would that change this brief? Format this as a one-page trading brief I can reference for the next 2 to 4 weeks. What comes back is a complete regime-adjusted plan. Bull regime, 5 to 8% position sizes, bias toward breakouts and pullbacks in leading sectors, normal stops, full deployment, pullback within a bull, tighten to 3 to 5% per trade, focus on mean reversion setups, look for entries near the rising 200-day, stop slightly tighter, bear 1 to 3% per trade maximum, avoid breakout longs, prefer cash or short setups, stops tight, expect more whipsaw. That's the output, not be careful, actual parameters for how to trade the current environment. Market regime is the context for every other technical tool we've covered in this series. Chart patterns, indicators, volume, moving averages, momentum, Fibonacci, VWAP, sector rotation, watch list filters, all of them perform better when you apply them in the right regime. The 3 prompts we covered today, SPY structure, IWM confirmation, regime to strategy translation, take about 10 minutes to run. Do it once a week, every Sunday before the market opens. If you found this useful, subscribe because the next episode starts a completely different format. We're moving from ChatGPT prompts to Python, building systematic tools that run these analyses automatically every morning before you've had your first cup of coffee. The first one, how to scan 12,000 stocks in under 60 seconds. I see you Thursday.